Now that we understand supply and demand, market structure, and liquidity, and how all of those concepts are combined, the next logical step is to move into more of the advanced supply and demand zone concepts. These concepts will improve the overall probability of a supply or demand zone being respected, because at the end of the day, when we're looking at supply and demand zones, we want the highest probability that a trade will play out. We want to combine all of the factors that we've learned so far and put ourselves in the most proper way to win when we are looking at building up a trade idea. So when we're looking at supply and demand zones, one of the biggest and most fundamental components of improving the overall probability of a supply and demand zone is a break of structure. Now, this break of structure can be in the form of swing structure, substructure, or minor structure. Depending on what level of structure it breaks will improve the overall quality of that supply or demand zone. Because of course, if price breaks swing structure, it takes more power to break swing structure than it does, say, minor structure. So in theory, the probability of that supply or demand zone being respected ends up increasing overall. So if we have an uptrend, for instance, price moves to the upside, we break this previous structural high, we form a demand zone, whether that be range created demand or pivot created demand. We're looking at this demand zone. So what we can see very easily is that price has broken the previous high, and our expectation is that price would return back to that demand zone and then tap into it. We would look for our entry and it would move to the upside. And the same would be true if we were looking at something in a bearish trend where we break this previous lower low. We would be looking for a pivot created supply or a range created supply, the expectation that price would return back to the supply zone. We would look for our sell opportunities within the supply zone, and then price would continue on. But the biggest factor to consider is the fact that price has broken structure. Now, what we might also have, if we're looking at price action, is we might have something like this, where price has created a range in swing structure. We're starting to create substructure where we're creating lower lows and lower highs as we create that pullback. And then we switch to minor structure, and now we're breaking structure. Now what we can see is we have a few different points to look at. We have 3 different breaks of structure. We have break of substructure creating minor structure. This would be our change of character. We have a break of minor structure with this high here. And then we have another break of minor structure, which is also a break of the swing structure. So what this provides us is 3 different points of interest that we could be looking to buy at, as all 3 have broken various points of structure. Now, what I had said earlier is that something that breaks swing structure is going to be higher probability in terms of the overall strength that it takes to break that bit of structure. But one thing we should also take note of is where we are in the leg of price. Now, what I mean by that is if we look at the range of the swing structure and look at where the last demand zone that was created that broke swing structure, we can see that it's the very last demand zone, the very top demand zone. And while that might be a high value area to look for buy setups, more often than not, price likes to go to the extreme. And we know from the liquidity videos, what does that mean? It just means that we're going to be filling internal range of liquidity. We're going to fill a liquidity void before we move to the upside. But what we could see initially is we could get a reaction, because what we've said in many videos is that price may react off of supply and demand zones before it commits to an extreme. And what does this end up doing? It just ends up building more liquidity for price action to come down to the extreme. But at the end of the day, the main thing to take note of is that to improve the probability of a supply or demand zone would be through understanding breaks of structure. Again, it can be a break of swing structure, a break of minor structure, a break of substructure. Of course, the highest probability would be to look for demand zones that break swing structure. And then one thing that could be said through all of this bit of price action, because of course, in theory, this would be the demand zone that broke this swing structure, but the start of that move actually came from this, which is the extreme. So in theory, the push to create that move to the upside would have derived from the higher low that is forming here in this uptrend. Because if we did something like this, what we can see is this was a high, this took out the high, this created a demand zone. We've broken structure from that demand zone, price returns to the demand zone, and then once we tap into that demand zone, price then moves to the upside, breaking the newly created higher high, and the price continues moving to the upside. And then we would just wait and see where price ends up moving down to then look for another potential entry, or at least an understanding of where price is likely to continue moving to the upside. So what we'll do is we'll just look at a couple examples of supply and demand zones here on euro dollar. We're gonna look at 15-minute. We might switch to 1 minute as well. But for now, we'll just start on the 15-minute and see how we get on. What we can see if we're just looking at this little bit of price action, we can see that we have a few demand zones already clearly marked out. You can see that we have swing structure right here, price ranges, and then we break that swing structure. And if I just move the chart to the right, and what we can see is because we broke swing structure, we created range, created demand. We're in an uptrend already. If I just scrunch the chart a little bit, we can see that we're in an uptrend. So we know that the expectation is that price will continue moving to the upside. We can see that price taps into this demand zone and continues moving to the upside. Now, if we add on some liquidity concepts, we can see that we're just building a bunch of liquidity just above this zone. So it improves the overall quality of this trade setup. But again, the reason why the probability increases on this particular demand zone is because this broke swing structure, and we can see it also broke some minor structure within, because of course we have some movements, especially if we're looking on, say, the 1 minute time frame, where we switch from substructure to minor structure, we break that minor structure and continue. So we have a couple different points, but where does it come down to? It comes down to essentially the origin of that break of structure, that break of swing structure, and then price continues moving to the upside. And then if we look at this next bit, again, we have swing structure. Price breaks that swing structure, continues on making higher highs and higher lows. Price returns back to this demand zone, reacts, and then continues moving to the upside. And if we're looking at it from an intraday lens, these areas are more than enough to bank percentage, to take trades, to take longs, targeting prior supply zones and targeting internal range liquidity. Now, if we look at this area, we can see that we break swing structure once again. We create a demand zone. Price returns to that demand zone and continues moving back to the upside. Now, of course, it's not always going to be a perfect world where demand zones get respected. We did discuss in this area about the variance between the 15-minute and the 4-hour, but what we can see is price breaks swing structure. We create a point of interest. If I just do that, a little demand zone. What we can see is we do get a reaction initially, but where's price ultimately going? And this is where it comes back to the combination of looking for more of the extremes of demand and supply zones. This is a little bit more complex, I'll admit, because we continue to break structure to the upside before we come down to this last untapped demand zone. But if we look at it in the lens of liquidity as well, we have liquidity, Once we start reacting off of this point of interest, we're just dropping more liquidity. We have a large liquidity void, and we have this point of interest. And if we just compare the breaks of structure as well and the momentum that's come, we can see that this is a very large range. And we know and understand that ranges are, in theory, a collection of orders that are existing in the markets, because the market is said to be at fair value. So there's a lot of orders changing hands in and around this zone, which is why price is contained in a small range. Once there's enough orders that create that imbalance, price then moves to the upside. And what we can see with this large candle is there's a lot of momentum, a lot of volume in that candle, and price then continues moving to the upside. Now, if we do look at this bit, we do have some wicks here, and what we can see is we do break some small structure, not much of a pullback to consider that a full-on 15-minute bit of structure, but it's definitely worth noting. We can see that it does create demand, price comes down to that demand. So this is valid because it breaks minor structure and continues moving to the upside. What we can see is there is a demand zone that would be resting within this wick, more than likely found on the 1 minute time frame. Price taps into that and then continues moving to the upside. Again, we break structure. We get a more clean pullback because, as we can see, this is a pretty messy pullback. It doesn't move very far in the grand scheme of things, about 9.5 pips. This one moves about almost 13, so a little bit bigger pullback. And what we can see is the move that breaks structure. If we're just comparing, again, we're comparing this break to this break. What we can see is this is a nice clean push that breaks structure, a lot of volume in this candle, a fair amount of commitment. If we see, we break it by about 5 pips, whereas this one, we break it by about 2 pips. So definitely, if we're looking at this versus this showcases that a lot more orders have come into the market versus this one down here. And as a result, what we can see is that price reacts initially and then continues falling. And then finally, the same can be said for this area. Yes, we do break structure. Yes, we do have a potential demand zone here. But what we can see is price reacts on a very low time frame, as we can see in this wick right here. If we were to look on the 1 minute time frame, we would be able to see that this is a reaction, a a very small one, price moves to the upside and then continues falling down. We test this next demand does not hold. Why? Because we have this much larger demand zone to help propel market. But we're able to use the understanding of breaks of structure to understand demand zone's likelihood of probability. And then what we can do to add just to that is just comparing the breaks of structure on previous zones when we start to get price action that's starting to do this sort of stuff. Again, this begins to create a variance on the 4 hour where the 4 hour is still continuously trending to the upside. This is more of a pause in the market on the 4 hour, but on the 15-minute, we're starting to see a slowdown, a potential switch in trend, and then a move back to the upside, and then followed by the real 4 hour pullback. So now if we just move on to the supply zones, now that we've switched from bullish to bearish, what we can see very quickly is that price creates a low here. And at this point, this is still substructure within the swing structure on the bullish side until we actually break this low. And what we can see is we create more substructure, and then price actually breaks structure. So we have two zones that we've mapped out and been able to map out. There's actually a third one right there as well, because what we can see is this zone right here broke this low. Therefore, it is a valid supply zone. We have a nice large wick, which we'd be able to refine our zone. And then we also have this low here, this zone right here broke this low, therefore valid point of interest. And finally, this supply zone broke this low and these lows, and therefore making it a valid supply zone. Now what we can see is when we have multiple supply zones stacked with amongst each other, we have to start putting on our liquidity cap as well, just to understand what's happening from an order flow basis. But what we can see is the very first point of structure that broke arguably the swing low, but also broke some of the substructure right here in the most recent substructure before we've seen this nice move to the downside. Which again, what we should also take note of is we reacted off of this demand zones. So although we've switched from bullish to bearish, we're still reacting off of demand. Demand is still being respected. When we start to look at the higher time frame, we're starting to see that this is a 4 hour pullback. So we have no inclination that we're going to be long-term bearish, but it's something to keep in mind, especially once we start to see that this demand zone fails and we start to see supply just getting consistently respected. Then that's when we can really start to shift our bias. But in the meantime, we can start to fill in some of the void here. Whether you took longs here or not, we would be able to use these supply zones as potential targeting areas. Again, if we look at this first zone, what we can see is we do get an initial reaction, but no follow through. We get an accumulation or a range, and then price then continues moving to the upside. Where does it return to? It returns to this supply zone, this wick that breaks this structure right here, and then ultimately breaks this structure. And what we can see is this is a pretty powerful move. And what we can see is we tap in and then we start to run off. Now, of course, this leaves this one open as well. And what we can see is we do have equal highs that have been created just above this zone. So in my mind, this would be a valid zone, although I don't have it marked on. What we can see is we just tap into it. So if I just draw on a supply zone just to articulate the point, you can see that we just barely, or we can see is we just barely miss it. If I just zoom in really close, we can see that we just get into the vicinity. We don't actually tap into it, but that does provide us with the understanding or an opportunity that this trade would have been valid to look for an entry. Now, of course, if we refine it more to the wicks here, because we have more of continuation wicks right here, we get a nice tap. But if we're looking for more of that full, clearly developed pivot supply, we would have something more in this light, because what this doji represents is a large buy before the sell, which would be indicative of our pivot supply. It's also a doji on a lower time frame is a range, so this would also be considered range created supply. Again, you could also use these two wicks right here, because on a lower time frame, what this is representing is this sort of phenomenon, which is our pivot supply. But what we can see initially is we get a small reaction. All of this just becomes liquidity. We take that liquidity, we tap into this next zone, and then we start to see a true runoff. And then what we'd be doing is looking for demand zones to hold. We have this demand zone here. What did this demand zone break? It broke this small structural high, but more so this structural high, because as we can see, as price has created this push on 15-minute structure, we're starting to create substructure. We break the high, therefore we have a valid demand zone, so we'd keep our eye on that demand zone. And if we start to look at substructure just a little bit, we have this high, we have a demand zone right here, we tap into it, price continues on, and then we have a demand zone here that breaks a little bit of structure. We don't actually quite tap into it. So there will be times when price creates demand zones on a minor structure or substructure basis, then they do not get hits and they'll be used as internal range liquidity. So this is why the concept of supply and demand and internal range liquidity and market structure in combination becomes incredibly important, because we need to use all of these tools to better understand what's happening. Of course, it's best to start looking at supply and demand zones that are present on swing structure versus minor or substructure, but we can still use them if the overall narrative and trade idea that we're developing makes sense. But we always need to run it through, is it being created for liquidity or is it being created for reasons to actually action and follow through with? But again, what we can see is we tap into this, and what are we creating with all of these highs right here? We're creating liquidity. What we can also start to see is we're starting to create liquidity to the downside. We're starting to see that shift in momentum. We're starting to see supply being respected. Demand is also being respected. So right now price is more or less being squeezed. We've obviously seen this supply zone fail. We've seen this supply zone fail. Why is this supply zone valid? Let me just clear off all of these. Is because if we look, we have this low right here. It has broken structure. But of course, like I said, we're in this range of 15-minute swing structure. Then we start to create substructure. Now we're creating minor structure. We see a minor structure break, valid point of interest or supply zone. And then what we can see is we create minor structure, we break minor structure, we create substructure, and then we start to create more minor structure and continue dropping to the downside. And what we can see if we just navigate to the left, what do we have here? We have some wicks. And what we can see is we do break structure with those wicks. It's a little bit more lower time frame again. And this is where sometimes understanding the fractal nature of the markets comes into play. Not only that though, you don't have to trade that initial reaction on more convoluted structure where it's breaking very minor structure. You can use that as a basis to then start looking for confirmations and overall trades that are in line with that. So when you're starting to see a supply zone getting respected like this one, and then you start to see something like this where price is continuously falling, we're seeing breaks of structure and supply zones being formed, whether it be pivot or range created supply and demand. What we can then do is start to look at those particular areas for potential trades. And again, what we'd be more or less looking at is once price returns to these levels, going on to the 1 minute for our entry criteria. But of course, we can also use the 15-minute to take entries. We'll cover all of the entries in the next section, but it's just something, again, to get your mind thinking. And then just looking at this in a liquidity perspective as well, what does this end up creating? A liquidity void that gets filled. We tap into a supply zone here. But all the while, what are we doing? We're creating liquidity as price continues dropping. What we can see is this demand zone gets respected once more. If I just drag this over, the reaction is not very big. We can see that price failed to take out this high. Therefore, this low would be considered targeted. What do? We move to the downside. We take the liquidity that rests below all of these equal lows. So we've taken a lot more internal range liquidity. We've reacted to our demand zone, and that's where we see that push to the upside. All the while, though, we know that we're starting to switch bearish on the 15-minute. We have a untapped or fresh supply zone that has yet to be taken. And what we can see is this is more at the extreme that broke the swing structure on the 15-minute chart. And what we can see is we've created a lot of liquidity above it. We've created a liquidity void. We have a liquidity void that filled here, liquidity void that filled. But what does this end up doing if we have multiple liquidity voids? It creates a lot more liquidity. The fact that we have this supply zone creates the understanding that this liquidity that's created is actually relevant. Now, of course, if we just had a bunch of liquidity resting, but nothing up here, then there would be no real discernible reason that this liquidity needs to be taken before any real move happens. And what we can see is then price takes the liquidity, taps into the supply zone, and then continues to the downside. And that's when we start to see price begin to shift from bullish to bearish on the 4-hour chart. We start to see daily breaks of structure, and then the trend begins to shift from bullish to bearish on the higher time frames. Now, one thing I'll do just to continue explaining things a little bit further is we're just going to look at price action in this little bit of area, look at a couple zones on the 1 minute. Why? Just because then it allows us to filter out some zones that we're looking at. It allows us to understand the lower time frame market structure, and more specifically, it just gives us a lot more examples that we can very easily run through in a little bit more quick fashion. So we'll just start in this area right here. So we can see if we're just looking at this, we're in an uptrend. We start to break to the downside on the 1 minute chart. Of course, we are bearish on the 15 minute, and we're starting to see a move to the upside. We can see that price has created equal highs. We've broken structure. So what we can see is this point has broken structure. We've broken swing structure, and we've begun to break substructure and taken out all of the internal range liquidity. And then price has broken that structure and then continued moving to the downside. So looking at this as a valid demand zone is definitely reasonable. It makes sense, and it is entirely valid, especially if you were to refine it to, say, this wick right here using lower time frame refinements. Again, this would be more of a seconds demand zone then, or something like this. Of course, we do spike below it, which is an indication that price is more than willing to trade lower. But at this point, if we didn't have this bit of information, we're just waiting for price to react. If we're looking at this, yes, that is tradable, but more than likely, you're not really going to get a whole lot of a move out of that. But as you can see, this demand zone was valid because we broke structure. But again, this is where multi-time frame market structure really comes into play, because now we're looking at the 1 minute. We know that the 15 minute, the 4 hour, and the daily are bearish, so looking to buy is incredibly risky. If you are looking to buy in a counter trend perspective, then you need to be much more aggressive. But we'll focus more or less on the sell side of things, just because we are looking for pro trend moves. Those are the easier, or arguably easier, moves to catch, and those are the ones we should be focusing on early on in our journey, because it's easy to try and catch a falling knife or try to call a top or call a bottom, but it's a lot harder to actually trade them. And if we can shift our mindset from trying to find reversal points and trying to instead follow the trend, our trading just becomes a lot easier to manage psychologically, and it's just a lot easier to look for trades and be in trades when they're pro trend. So now if we look at this supply zone, what we can see is we have a break of structure and we have a break of swing structure. Also, we break 15-minute swing structure. So there's a lot of confluence, there's a lot of structure breaks that are as a result of this particular move, because as we can see, we go just like that and break structure. Of course, if we're looking on 15-minute swing structure, we have this entire move. And now we're just looking at areas that make sense. And if we just look at this move in general, what we can see is we break structure here, we break structure here, we break structure here. So in theory, there may be a valid supply zone in these wicks. We can see that we break structure would be from this point. We break structure here, therefore this would be a valid supply zone, and as we can see, it does get respected. And then we now have broken real structure, a lot of structure. And if we're just factoring in, this is where it comes thinking critically about the moves, as well as this move that has broken all of this structure, taking out the 15-minute swing structure, the 1 minute swing structure, and some of this minor structure. We can see that that move is a lot bigger and more powerful than all of this mess in here. So it gives us a little bit better or stronger indication that this is probably going to be a respected zone. And what we can see is the zone itself is drawn using this pivot, which is this large bullish candle. But what we can also do is we can refine it to this top wick, or we can refine it to this inside bar, or the inside bar plus the wick. This is where refinements on your own personal study will come into play. There is nothing wrong with using any of those methods that I just described when you're marking out this particular supply zone. And as you can see, regardless of the way you use it, this ends up being a valid tap into that supply zone that we could very much look for a particular trade. So just for information's sake, I'm going to use the inside bar, but also factor in this wick right there just to include that, because what you don't want is price to tap more into this where we have a supply zone on the seconds time frame, because what we know with wicks, when we start to see breaks of structure, things like that, where it creates supply zones, that more than likely this is a supply zone on a lower time frame. And as we can see, price taps into this and then continues running off. And adding on to the liquidity concepts as well, we get a strong move away, and then price has a larger void to fill. And what we can see is we also get liquidity that's created. We have these equal highs, this collection of equal highs. This is what we refer to as inducement. The inducement is the liquidity built for the purpose of tapping into particular zones, because as we can see, we created buy-side liquidity in the form of equal highs just below this supply zone. And what ends up happening, we take the liquidity, we tap into the supply zone, and then what we can see is price then continues moving to the downside. And what we can see is we break structure, we break structure, we break structure. What is all this? This is internal range liquidity that price is taking as it continues moving to the downside. So these end up being targets. And what we can see is we don't actually fully break external range liquidity. We break it just by a pip or so, and then price pulls back. What we can see is we don't get any true taps of supply, because of course if we were looking at something, we'd probably be looking at this candle right here as it broke structure, or something up here that broke structure at more of the extreme. We don't get any of that, which is fine. The markets don't necessarily have to play ball with us all the time. And then what we can see is all of this complex structure. We can start to see we get small breaks of structure, get taps in. This is again looking at more of the fractal nature of the markets, because we break structure, we come back in, we tap into a supply zone that rests within this inside bar, which would be our range created supply, and then price continues moving to the downside. We break truly this structural swing point. Now if we're looking at all this, what do we have here? We have an inside bar. This inside bar is the last point or range before the break of structure. We've broken swing structure, so it's a logical spot to look for sells, and we can draw on a supply zone. It gets a little bit messy. And what we can see there is we have that. And again, if we're just looking at what this little bit of price action represents, and even this little bit of price action, this is inducement. This is liquidity built, buy-side liquidity built just underneath the supply zone for the sole purpose of price to tap into that, take the liquidity, and then continue moving to the downside. And the beauty of this particular setup, depending on how you play it, is we break structure, we break structure. We don't actually break structure here, and we get a pullback. Where is it pulling back to? Now we have a couple different options we can use. Again, this comes down to your own refinement and understanding of supply and demand, but what we have is we have a full pivot supply, so we could use this entire range, which would allow us to capitalize on this movement, or we can use our refinement, our fractal supply and demand zone refinement, and understand that this right here is, again, the pivot supply that we could also use. So we can use the larger, more clear pivot supply, which is basically from this range low to this range high, or we can use our refined pivot supply that would be from these wicks. Again, if I was looking at stop losses, which we won't get into too much, but I would want to factor it above the supply zone just to give the trade room to breathe. But again, we'll talk about entries and things like that in the next section. So now what we can see, if we just continue on a little bit further, is price is continuously moving to the downside. What we can see is we don't really, again, have anything that's showcasing that price is tapping into necessarily. We don't really have any supply zones in here. We take out external range liquidity, and then we continue moving. We get a very small pullback, so whether we consider that structure is a whole different story. It's about 2 pips. I personally would not consider that structure. I want to see at least 5 on a 1-minute chart to consider that a pullback. And then what we can see is price then breaks to the upside. So when we're looking at our substructure, we're starting to see that price is starting to break some of these internal range liquidity. But we also know, if we're just looking at it from structural standpoint, that our 15-minute swing structure would be this entire move. So we know that price can move within this range to still remain bearish. We also know that the 4-hour and the daily are also bearish. We also know that from a 1-minute perspective, that the true move would be something like that, as this is more of a pause in the market. And more specifically, what this is indicating to me is an area of liquidity that is more than likely going to be run. This is buy-side liquidity being set up for internal range liquidity to be tapped into. And then what we can see is we do have a supply zone here. We break structure, we break structure. And what we can see, if we just run to the right, we do respect it, but we also wick a little bit higher than that particular supply zone. And what we can see is, if we just look to the left, is yes, it does react off of the supply zone that we were already looking at here, the pivot supply or this pivot supply. And what we can see very clearly is that yes, this supply zone worked for this, but then what we can see is this candle actually ended up taking out all of this internal range liquidity and tapped into it. And if we just look at this right here, we break structure. This is what actually created the extreme break of structure. And what we can see is, if we just draw it from right here, we're just above it. But if we look at the pivot, price taps into that and then continues moving to the downside. So sometimes you have to read in between the lines. You're never going to get it perfect, but this is when stop loss placement becomes so key. Because if we're just looking at this bit, if we're looking at trading off that, there's absolutely nothing wrong with it, because as we can see, we do get a reaction. And if we look at this on a lower time frame, what this ends up showing us is a change of character. We're starting to see price action change from bullish to bearish, and then we start to get confirmation that we're switching back to bearish when we get that second actual break of structure. And then we'll just carry on a little bit further. I know this video is probably drawing on a little bit longer than I was initially expecting, but I just want to make sure that this is very clear. And what we can see is we do have a very small break of structure. Again, this is looking at fractal market structure. We're still trading within this 15-minute leg of price or this 1-minute leg of price. We haven't actually broken closed above this high, so therefore we are still bearish. So if we're looking at that from that perspective, this is our move, so our impulsive move. We have substructure. We're starting to break very small structure, so we're starting to shift to minor, tap back up, and then we're starting to create minor structure. We create some more substructure, and then we start to create more minor structure before we actually take out that swing structure. But as we can see, if I just zoom in just a little bit here, we have a break of structure, albeit very small and minor, and probably not something that I personally would be wanting to trade, but we have a supply zone. And what makes this a little bit stronger probability that I would be looking at, potentially looking at this supply zone, is the fact that we have inducement being created. We have buy side liquidity once again being created just underneath this supply zone. We also have sell side liquidity being created. We know we're in a bear trend, so now we're just adding in all of the components to say, you know, I know that this broke structure, but the break of structure was pretty weak, but we're super bearish. We're still following that trend. We have liquidity being dropped to the downside, so we know that at some point it's going to target this, and if price is going to continue to the downside, this is the next spot, as well as this, and then before we take out the swing low. We've broken very minor structure, like I said, and we're also creating inducement. We also have a liquidity void. Price taps in and then continues to the downside. Now, if you didn't take that initial trade, that's fine, because in my mind, this is a fairly sketchy looking supply zone in terms of basing it off of this minor break of structure. We can add on to why this zone ends up being a little bit more higher probability in the next videos, but what we can see is this would be our extra confirmation. So we've seen this one play out. We understand why it played out. And what we can see now is we've targeted the liquidity. So the next logical spot is we're going to break swing structure if we're going to remain bearish. We're seeing demand failing, so it makes sense that the next logical stop would be here. We can see that we break structure, and we continue moving to the downside. We do have a supply zone here because we broke structure. We have a supply zone here because we broke structure. But of course, we're trying to focus on extremes. We're trying to factor in liquidity. So it gives us an understanding that this extreme portion is probably the better route to be looking for a trade. But of course, if you looked at these areas, there's nothing wrong with that. It's just being able to react off of certain elements, because as we can see, we get a small change of character. We have a pivot demand. Demand holds. Where is it likely going to go if demand does hold? Well, we're going to attack internal range liquidity before we actually move into supply and continue targeting those swing lows if we're going to continue bearish. So what we can see, again, we have inducement. We even have a little bit of inducement here. All of this, again, is just internal range liquidity that's being targeted. Now I have this zone drawn using this bit of area, but what we can very easily do is draw it just like that. And as we can see, similar to the example previous, we just barely tap into that zone. So arguably if you got tapped in that trade or not is a whole different story, but it's tapping into it. And what we can see is if we just start to look at supply and demand in a slightly different way using refinements, we could use this as our zone. We can use something more like this. It really just comes down to where you refine, how much studying you've done. I cannot stress that enough. You need to put in the work in terms of supply and demand zones, understanding what works for you, what makes sense for you that you can repeatably follow. Because if you're questioning what you should be using, you haven't studied enough. But I'll give you a little bit of insight why I used this zone specifically is because this is more of a doji. We also have that continuation pivot supply price action, but more specifically because this is a doji, it gives me the insight that this is more of a range on a lower time frame, and that's somewhere or something that I should be mindful of. So this would probably be a good spot, but I'm understanding that price could react to even this wick. So it's just something that I either cover the wick, it's a pip. So even if I have my entry down here, a 2 pip stop loss or larger is not going to be a big deal. So something to keep in mind, especially if we just weigh up the risk to reward. So if we just framed up a really quick trade, just from a risk to reward perspective with a 2 pip stop loss, even just targeting the lows, we have about a 1 to 4.3, which is still a great trade. Personally, I like 1 to 5s at least on minimum, but we know that if we're going to break this swing low, chances are we're going to run below it. So a 5-hour would make sense. And then if we see just below, we're starting to tap into a higher time frame demand zone. So we would be able to then gauge that price is going to tap into that. But now that we're tapping into that, this might be an indication that we're going to start to see upwards momentum. And what we can see is if we just continue on just a little bit more, we break structure, we create a supply zone is respected. And what we can see is, again, we break structure, we create a supply zone here. We do have one up here as well. If I just get rid of some of my markings, but more specifically, if we're just looking at true structure, we get something like that, a real push. So we'd be able to look at something like that. What do we see? We get a reaction, but not a follow through. We don't actually break this low. Therefore, this high is more than likely going to be targeted. We target the high, create a new higher high, but we haven't actually broken and closed above it. And then what we see is price comes down, we sweep the liquidity, we range, and then we move to the upside, breaking structure to the upside on the 1 minute. We've reacted off of a higher time frame point of interest, and we've seen a change of character. So looking at this would be a valid demand zone. I'm not sure why that's not there anymore. There we go. So now we have a valid demand zone. We have range created demand if we use the entire range, or we could just use or refine it to pivot created demand, which would be that. You can see price respects it, continues moving to the upside. And what we can see is we have a inside bar here that breaks this structure. We break structure. Ultimately, we end up breaking swing structure. If we look at the swing structure and we look at the most recent move, we can see that we have a demand zone here. More specifically, right here, it does not get respected. We have this wick right here, doesn't get respected. We have this demand zone right here that broke this structure. We get a reaction, moves to the upside, but where do we react off of? We react off of supply right here in this inside bar. Why is that inside bar valid? Because we've broken lower time frame structure as well as structure here. We've reacted off a demand zone. So now we're playing the fight between supply and demand. Supply is respected, and then what ends up happening, demand fails because this demand zone was unsuccessful in taking out this high. Therefore, more than likely, the low is going to be targeted. And then what we can see is we have this inside bar, which was basically responsible for the initial break of all of structure that we're seeing. Price reacts off of it. We get a fairly weak reaction. Well, as we can see, price reacts off of it. We break structure. So what we can also do is look at this wick using pivot demand concepts using our wick refinement. We can see we break structure, we continue on, we break structure, and then price continues moving to the upside. And this is the best way to really filter your supply and demand zones, is looking for breaks of structure. If price doesn't break structure, chances are it's not going to be a high quality supply or demand zone. Chances are when you have multiple, then we need to start looking at what is being built as liquidity and what is actually causing true momentum to enter the market. Because if we look at this bit of structure, we can see that we're starting to build trendline liquidity. Once we react off of this, what do we end up building? We end up building equal lows, therefore sell side liquidity. We have a liquidity void that is needing to be filled. Most of it gets filled in that sort of respect. And then what we can see is we have this demand zone because it breaks structure, breaks structure. This is also at the extreme versus this. There really isn't a whole lot of liquidity. And what we can see just as price continues moving on, what do we end up doing? We drop a lot of inducement before we get the real tap and then the move off to the upside. So what I recommend doing now is hitting up your charts and start looking at the supply and demand zones that you've mapped out previously, and also map out new ones, and just apply the concept or the understanding of breaks of structure and just understand which ones work, what they didn't. And if you have instances where you have, again, multiple demand zones, for instance, in an uptrend, start comparing those demand zones amongst each other, look for momentum, use the concepts of liquidity to understand why a demand zone failed and the fact that it more than likely created internal range liquidity. This is why all of the concepts leading to this point have been delivered in the way they have been delivered, and why everything is so intertwined within itself is because it's going to take some thinking when you're looking at these supply and demand zones to truly understand what's actually happening behind the scenes. You have to compare multiple demand zones, understand where the momentum came from. Has it been created to be actually tapped into to be used for order flow, or has it been created for more or less inducement or, again, building of liquidity above a demand zone or below a supply zone? So definitely take a look at all of your supply and demand zones and apply the break of structure methodology to those zones. Another probability increaser for supply and demand zones that we can use in our trading would be using the concept of liquidity, more specifically the sweep of liquidity when a zone is created. So if we have an example of equal highs, a sweep of those equal highs, and then price continues to move to the downside in a rapid manner, we have a formation of a valid supply zone. Then the flip side, we would of course have equal lows, a sweep of those equal lows, and then a move away, creating a valid demand zone. We can also have a similar situation where we have a swing high, a sweep of that swing high, and then a rapid move to the downside. And then on the flip side, a swing low, a sweep of that swing low, and then a move to the upside, forming a demand zone. Now, of course, in many of these cases, we're also going to get a break of structure, but not always are we going to get a break of structure. So the combination of breaks of structure and sweeps of liquidity are going to be massive probability increasers for supply and demand zones as we're looking at price, because what this is showing us is that price is taking out liquidity before a move's happening. So it's inducing more people to get in to a particular trade, because what it's doing is inducing orders, tapping into orders that exist above these highs or these lows, and then price is creating that imbalance for price to continue moving. And then we'd be looking at that area as our point of interest, our supply zone, or our demand zone. So what we'll do now is we'll jump into some examples here on the 15-minute chart, probably go through some of the similar ones we went through in the previous episode, but we're going to be looking at it through the lens of sweeping liquidity and just getting an overall understanding of liquidity being swept. So if we look on the 15-minute chart, but if we look at this, what we can see is we have a swing low, we sweep that swing low, we have a collection of equal lows, and then we sweep that equal lows. But what we can see is if we just look at these two lows, they are equal. And if we just look in the top corner of the trading view chart, we can see the open, the high, the low, and the close values. And what we can see is the low is 18,409 on this candle, and the wick on this candle is 18,409. So they are perfectly equal lows. So they haven't taken out each other, but what we can see is price has taken out the liquidity of the lows prior to that, because again, we're factoring in the fractal nature of the markets. We understand the importance of lower time frame and that this low is important on a lower time frame. We've swept liquidity and then we've continued moving to the upside. Again, we've broken structure. That validates our point of interest. If we look at this next one, what we can see is we create a swing low right here, a collection of swing lows right here. This point of interest, or this point here, this candle, this doji, creates a range. It takes the liquidity and then we break structure to the upside. So therefore, this is a high probability demand zone. Why? Because we've broken structure and we've also swept liquidity before the formation of the zone. And what we can see is we get that reaction and price then begins moving to the upside. If we look at this zone, what we can see again is we haven't actually swept any liquidity. So that doesn't actually add any value to that. It's just a break of structure. If we look at this one, what we can see is we have a swing low here. We do take out some liquidity, but again, when we were looking at this, we start seeing a bunch of this liquidity being stacked, liquidity void. We have some inducement here, but all the while we know that this zone is just creating a lot more liquidity as in the form of internal range liquidity, the inducement before the demand zone, and price then continues moving to the upside. So all of this does not include really any sweeps of liquidity that we really need to concern ourselves with. It's really just looking at something like this or something like this. Now, of course, you can get into specifics. Yeah, of course, we've swept liquidity. We've tapped on this. We got a small reaction, but we barely broke structure. We have a lot more liquidity resting under here, so not the greatest area to be looking for buys given that bit of information. What we can see here is, yes, we did sweep liquidity. We created equal lows, we swept liquidity. So in theory, we could look for a demand zone in this area. We also break structure, so the validity is there. But again, we didn't break structure with a lot of force, and we're starting to see these stacked lows, which gives us the indication that we're just creating a lot of internal range liquidity. Again, as we had mentioned in the previous liquidity videos, this ends up being a variance on the 4 hour, where price is still bullish on the 4 hour. We have that strong push, and we're just seeing the 15-minute changing its character a little bit before we get the true pullback on the 4 hour chart. We'll just move on. Most of these haven't taken any real liquidity. Yes, we have a swing high here. Yes, we have a swing high here. And in theory, on lower time frame charts, yes, maybe that would be a sweep of liquidity, but for simplicity's sake, we'll disregard those because we don't see a clear form of liquidity, so it's best to just move away from that. So I'll just carry on and look at this bit of price action. What we can see is we do get a bunch of equal lows here. We sweep liquidity, we tap into the zone, we do get a reaction, but then the reaction fails. Where does the reaction fail to? We react to this area right here. Again, no real sweep of liquidity, we just get a break of structure. So not the most clean cut or best examples to run through, but just to run through the same examples that we ran through in the previous video, where a lot of these were geared towards break of structure plays. What we can see, if we're just looking on the demand zone side of things, is we sweep liquidity, we create a point of interest within something like that where we get this pivot. But as we can see, and as I mentioned in the previous episode, is that we don't actually tap into that demand zone, but the rationale and the logic is still there. What we can see is we get some inducement, we get a liquidity sweep here. So what we can see is, although we haven't broken structure, we've swept liquidity. So we could be looking at this point of interest as well, or more specifically the wick. But as we can see, price doesn't actually tap into it. So we're trying to put the biggest probabilities in our favor, or put as many probabilistic factors in our nature. And what we can see is if we're just looking at this bit of structure, yes, we've broken structure here. Now we're operating within this range. Yes, we've taken out liquidity, but we haven't actually broken structure. And when we did break structure, this minor bit of structure, we didn't break it with any real force. So therefore, this point of interest, this demand zone, is probably not the highest probability or value for us. Now on the flip side, what we can see is we have liquidity here. We create a demand zone, we break structure with power, we come in and then we get a reaction, albeit slow moving, and we end up tapping into, again, this supply zone and move to the downside. But again, we can more than likely trade that about 27 pips. And then we'll just continue on a little bit further. Again, none of this swept liquidity. We took liquidity with this, so in theory, this could be a valuable point of interest for the future, but we don't know that for sure. Now what we'll do is we'll just jump into the 1 minute and go through the same examples as we did in the previous episode, just to continue driving the point home a little bit more. So we'll start in the exact same spot. We are in a downtrend on the higher time frames. We've switched bullish here on the 1 minute. And what we can see, if I just zoom in just a little bit more, we have equal highs, highs, highs. We sweep that liquidity and then we move to the downside. What we can see is we don't actually tap into that bit of price action, as we can see. What we can see is we start creating trendline liquidity and just swing high liquidity. We sweep it, that creates a valid supply zone, and then we get more liquidity. We sweep it and valid supply zone. Again, we break structure and we break structure. So we're just adding on to these areas of supply zone, because we know that this supply zone right here, this large candle, was valid because we broke structure right here. We broke this minor structure. We know that this supply zone is valid because we broke minor structure, and then we ultimately broke swing structure. But again, we can add on to that by also understanding that we took liquidity, and we took liquidity in the form of equal highs. And what we know is we took relatively equal highs, but more specifically swing highs and also structural trend line type highs. And we'll move on once again and just continue looking at price. What we can see again is price in this case just break structure. We don't actually take any true liquidity. We do have inducement, but there should be a difference between looking for a sweep of liquidity to form a point of interest, and then if we're forming some form of inducement, we would get something like that, where we've taken out liquidity to form our point of interest. We create inducement, or the formation, in this case, of buy-side liquidity, to fill the liquidity void, to tap into the supply zone, to then continue on. So there is a very big difference between inducement and liquidity. So in this case, this is inducement right here. We've created equal highs. We've swept those equal highs to tap into the supply zone. Then we continued. Whereas something like this, where we have equal highs, we sweep those equal highs, and then we see the momentum to the downside that creates the supply zone that we'd be looking to trade. Now, if we look at this example right here, what we can see is we have a swing high. We have a sweep of that swing high. It creates our change of character, and then price moves to the downside. We also have inducement, and we have price tapping into a supply zone, which is why this trade, and as I mentioned in the previous video, why this area was valid. It was just you needed a little bit more probability to look for this, because we've broken such minor structure, and whether you counted that as structure is totally up to your own bit of judgment and testing, as we know on a lower time frame, so seconds, that this would be a change of character and this would be structure on the seconds time frame, but if you don't trade or have access to the seconds time frame, which a lot of us don't, it's not something overly important, but it's just something to be mindful of. But yes, we have a very basic break of structure, but what makes this a little bit more high value is we have a sweep of liquidity, more specifically this sweep of liquidity, some of these equal highs here, or a collection of equal highs right here. It forms our supply zone. We do break that little bit of structure. We form a liquidity void, and we have inducement. Factoring in all of those components combined with the fact that we're already bearish is what makes this trade valid, or makes this supply zone valid to trade. Again, what we have here is we have the zone right here. We have our inducement, which in theory, we could also view in this case, in this particular case, that this is the liquidity before this zone. We've tapped into this zone, and then we've continued moving. We tap into it. Again, we have inducement. We have inducement. What we can see here is we swept liquidity. We've created a valid point of interest right here, but this is a zone that does not get tapped until much later. But as we can see, if we use this candle right here, or if we refine to something like this does wick it by like a pip, which is not a big deal, but something to keep in mind is we do get a valid point of interest, which is why this gets respected. So let me just make that a little bit smaller. You can see as we break structure, we break structure, we break structure, we break swing structure. This is that origin of the move that breaks that structure. We've taken liquidity, we tap into it, and then we continue. What does this end up being? This ends up being more of inducement to this tap into that zone. Getting a little bit messy with my lines there, but at the end of the day, again, we're trading lower time frame order flow, but we understand the higher time frame is bearish, and now we're starting to build up trade ideas. We're starting to see supply being respected, demand failing, demand failing, demand failing. We know that this took liquidity and broke multiple layers of structure, especially 15-minute swing structure, which is a little bit more valid and something we should be looking out for when we're trading the 1 minute. But we also start getting some inducements. We have an overall liquidity void that we're more than likely going to see filled. And then what we can see is we tap into that, and then we continue moving to the downside, and gives us a nice tradable range. And then what we can see is, we'll just talk about this one. If we look at this, we have a swing high here. We take liquidity of that, especially this. We break structure. We tap into this supply zone, and then we end up moving to the downside, breaking more structure and continuing on. Now we've tapped into this higher time frame daily demand zone, and we're starting to see a change of character. What do we see? We see a sweep of liquidity. We see a break of structure, which is also a change of character within this higher time frame point of interest. This is why this ends up being valid. If we didn't have a higher time frame point of interest here, and all we had was a sweep of liquidity and a change of character, and we're in the middle of nowhere, I would proceed with caution because we're still very much counter trend. But because we're in a higher time frame point of interest demand zone, this is where logically we could start to look for supply turning into, this is where we could look to start seeing supply failing and demand starting to be respected, if that higher time frame demand zone is going to be the catalyst to change the overall trend. And as we know with supply and demand, we're more than likely going to get a reaction from it, whether it's a full reaction that we can continue to trade or just a simple reaction that we can take small trades on. A whole different story, but this is why this becomes important, because if we're just trading this in isolation, you're going to have a bad time in many cases. But the fact that we've paired this with a higher time frame point of interest is what improves the odds of this happening. So sweep of liquidity, break of structure, which is our change of character within the higher time frame point of interest, range created demand, price taps into it and then runs off to the upside. Again, this one right here, you could argue that this took liquidity here before we move to the upside, but that one's a little bit harder to justify in my opinion because it just doesn't look as clean. So this is more of a break of structure play and a supply and demand zone flip, which we'll get into. And as we can see with this zone, sweep of liquidity creates point of interest, breaks structure, valid supply zone to look for selling. What we can also see here is sweeps a little bit of structure. Again, we're looking on the 1 minute. This would be on the seconds time frame. So this is about logically thinking what's happening on our time frames, understanding market structure, understanding liquidity, that this did break structure, although we broke some minor structure, and it did eventually break the swing structure on the 1 minute. So it is a valid demand zone. We do get that respect. But what we can see is we're starting to build stacked lows. We're starting to build equal lows. So the longevity of this trade is probably questionable. Factor in the fact that we have liquidity that's been swept here, a new supply zone that's been created. It's breaking multiple layers of structure. Gives us the indication that if we're looking to trade, this would be a logical spot to, at least at minimum, secure your risk, maybe even look for a hedge trade to see what ends up happening next. And then as we've seen, price takes liquidity and then continues more or less moving sideways, because as we can see, this is very much indicative to sideways price action. And then what we can see, if we just move on, we tap into this demand zone, we sweep liquidity, we break structure. This becomes a valid point of interest to look for trades. What do we have underneath it? We have inducement or sell side liquidity that just rests above the demand zone. Demand zone could be in this wick, or we could just use this entire pivot, which would be just a larger zone that price is accumulating on, and then price continues moving to the upside. What do we see here? We see equal lows, sweep of liquidity, gives us a point of interest. Price then continues moving to the upside. This is happening all the time, and it's our job to understand why it works and being able to put us in the best probability to win. When we can combine breaks of structure and sweeps of liquidity to our supply and demand zones, it adds such a high value probability of these zones being respected. But again, it comes down to understanding that in most cases, a supply and demand zone is going to likely get some sort of reaction, but we want to see, do we get an actual follow through or not? We can trade the reactions, absolutely, but we need to make sure that we are also being mindful of what's happening around price action, what we're interacting with, what market structure is suggesting, and what liquidity is telling us. Because again, if we're looking at this situation, this was a valid demand zone. We broke structure, we took some liquidity, we do get a nice reaction, but now we're looking at the overall higher time frame picture. We're still bearish. We are reacting off of a higher time frame point of interest. We're starting to build liquidity, so chances are price is going to respect supply or just barely take out external range liquidity and then start to see a pullback before we get that catalyst to move to the upside. And as we can see, price ends up consolidating for quite some time, takes out a lot more of this internal range liquidity, taps into this point of interest right here, this entire wick, just like that. Move that over, and what we can see is we tap into that. And what we can see, if I just zoom in on this as well, we break structure. That's pretty evident. We take liquidity on this swing low. We tap, break structure, and then continue on. This all becomes inducement and internal range liquidity for this move to actually happen. And what we can see is once we've taken out all of the internal range liquidity that exists, we tap into our extreme. We fill in liquidity voids. That's when we're going to start to see runs on swing structure, and that's what we see. And then if we just look more specifically in here, we can see we get a sweep of liquidity, a break of structure, valid POI that we can be looking at, a valid demand zone that we can be looking at trading. And that's the power of the sweep of liquidity. That's the power of combining it with breaks of structure. What I strongly recommend and encourage now is, again, looking at your charts, framing up your supply and demand zones using the liquidity concepts. If we have equal highs being swept and then a move to the downside, or structural highs and then a sweep of liquidity, or some sort of trend line liquidity, a sweep and then a move to the downside, these are all valid supply zones. On the flip side, if we get equal lows, a sweep of liquidity and move to the upside, it's a valid demand zone. Structural liquidity, sweep of that, move to the upside. And if we get trend line liquidity, something like that, a sweep of that, and then a move to the upside, that's also a valid demand zone. So this is what we should be looking out for when we're looking at our supply and demand zones to improve the overall probability of them playing out. Again, we're looking for reactions and follow through. We can trade the reactions, but it's more important than trying to get the follow through. But we don't know what's going to follow through until obviously it follows through. And that's why it's important to combine market structure, supply and demand zones, and liquidity concepts. That way we can build the highest probability trades. When we can use breaks of structure and liquidity sweeps in framing up our supply and demand zones in combination of the higher time frame structure and higher time frame supply and demand, we create such high probability trade ideas because we're factoring in different components that would strengthen the zones from being respected or not. And then also if we start factoring in how price returns to these zones, whether it's corrective, whether it's V-shaped reversals, or whether it is more rounded returns, that also will improve or diminish the probability of these zones playing out. So definitely take a look, definitely dig into this, look at previous trades you've taken, different markups that you've made, and just identify if they have created sweeps of liquidity beforehand. If they did, chances are that was probably a higher probability zone. But then again, similar to what I had said in the previous video, then we need to start looking at, if we have multiple zones, what is the most high probability zone? Are we creating liquidity? Are we sweeping liquidity? Are we targeting internal range liquidity? Do we have a lot of momentum from one zone versus the other? We need to start comparing and really thinking critically about what's going on, especially when we have multiple zones. Because at the end of the day, our job as traders is to take the information that the markets provide us, frame up pros and cons to particular trade ideas, and run it through a checklist or trading plan or series of steps that say, will I take this trade? Yes. Or will I take this trade? No. And that's as simple as trading ends up being once you have all of these concepts under your belt. But until then, you need to test and understand them, get your own flavor of them, and see what works the most for you, because what may work for some might not work for others. So it's important to do the testing. And I can't stress that enough, because the only way you're going to see this working in action is if you put the time on the charts to making sure that you understand how these improve probabilities and when it makes sense to use them. The final probability increaser that we can use for supply and demand zones is the concept of mitigation. And what is mitigation? It's essentially price tapping into a supply or demand zone and seeing the series of that phenomena occurring. So what we know is we have a sweep of liquidity, a break of structure that improves the quality of a supply zone that we're seeing. Now, if we start to see price tapping into a supply zone, we would consider that a mitigation, and what we'd expect is price to then move to the downside. And what we can see in this example is we've swept liquidity, we're breaking structure, breaking structure, breaking structure, and more importantly, breaking the swing structure. We now have formed another supply zone, and then price can continue moving to the upside, tap into that or mitigate, and then price then moves to the downside. What we can see, break structure, take liquidity, mitigate. And this can happen multiple times, and this is another way that we can start to improve the probability of our trades. So in the previous videos, we said that improving the probability of a supply or demand zone, we'd be looking for a break of structure, a sweep of liquidity, and now we're going to add on the concept of mitigation, and it's a form of improving the supply and demand zones and the probability that they will actually see price respecting them. So what we can see, if we move back to our examples again, this one is a little bit less common compared to break of structure and sweep. So if we're looking at the combination of these probability increasers, we would have, in order of succession that we would see, number one would be a break of structure. More often than not, we're going to see a break of structure. Number two would be a sweep of liquidity, and then number three would be the mitigation. The mitigation is more of a read between the lines sort of phenomena that we could use, where we may only see a mitigation of a zone that creates a supply zone, and it may break structure, but that might be it. It might not break structure either, so we need to read between the lines a little bit. This is where things get a little bit convoluted, which is why it's a probability increaser, but I personally wouldn't just look at mitigations in isolation for validating a point of interest. So if we look on the 15-minute here in the examples that we've been going through, what we can see is that we do have what looks to be a demand zone. We break structure, so in theory this is valid. We break structure. So we can look at that, and what we can see is price does in fact tap into that. We have a mitigation of this demand zone because, again, we broke structure. And then when we were looking at this zone, we can see that we swept liquidity, and we broke structure. So this makes this zone even stronger based on that information. So if we just look again, what we can see is we do have a little bit of structure break. We create a demand zone, but it sweeps liquidity. We don't actually end up mitigating anything. So again, not much happens in the way of improving the odds using the concept of mitigation. Then what we can see is if we just move on, we get equal highs, we get a tap, we mitigate something because we've swept liquidity. We haven't actually broken structure. So again, this is where things get a little convoluted, but we can look at this in a different lens. So let me just zoom in to make this a little bit clearer. So what we can see is if we just look at this, we can see that we took out the external range liquidity of this high, and then we got our pullback. We can say that on a lower time frame, this would more than likely be a break of structure, so we can start to look at it in that lens. Where did we break structure, or where did that come from? More than likely this inside bar, which would be a demand zone. Now, I wouldn't recommend trading the reaction of this demand zone, but what we can see very easily is that price respects that, it mitigates that demand zone, and then that's where we get the sweep of liquidity, the break of structure, and we're able to use that as our demand zone. And then if we just continue moving on, we can just see that, again, we have a break of structure, very minor break of structure, again, on the lower time frame. We have demand zones that rest in wicks, and then price continues moving to the upside. We get a little bit more of a confirmed break of structure, sweep of liquidity. We have a little bit of a demand zone. We have a little bit more of a demand zone, some inducement, and then price does react off of it, but we don't see a follow through. Similar to this situation, we see that price hasn't actually mitigated anything in this area, but what we can see, if I just move this over, we can see that price mitigates a higher time frame point of interest. So I'll just move this back over one more time, move that right there, and what we can see is price takes liquidity and then moves to the downside. We could argue that on a 1 minute that this is structural break, so we do have a break of structure, but more importantly, we have a mitigation and a sweep of liquidity. And what we can see in this wick, we have a supply zone. We tap into that supply zone, and then we continue moving to the downside. If we look at this zone, we also, like we had mentioned in the previous videos, that we have this, which is just a pivot supply zone. You can see that we mitigated this. We created that pivot supply zone. We've mitigated that, so we're just adding in the concept of mitigation. But again, we know that this doji is a range on a lower time frame, therefore it's probably a higher probability. This mitigation is a lot more proper. This zone leaves a little bit to be desired, and as we can see, if we just move on, we get that slight tap. So more specifically, we probably did tap into something more so like that. As we can see, we do tap into it. So however you look at that supply and demand zone, the logic is still there. We've mitigated this wick, we've broken structure, and then we've mitigated this, which adds a mitigation to that. This is still a valid point of interest because we haven't actually tapped into it fully. We get a little bit, like I said, which is why price would gravitate a little bit higher in there. And then if we just use our bullish example again, sweep liquidity, break structure, mitigated this area right here. So what we can see is we've mitigated a demand zone to the left, this one right here. We've swept liquidity and broken structure, therefore it is a valid point of interest. What we can see is price never actually gets to that point of interest. We have this area right here, which just breaks structure. And then we continue moving on. So we're moving between this range. We haven't seen any mitigations that are warranting anything. Price then continues. We tap into all of these zones. And then we can just move into this little bit of information. You can see sweep of liquidity. We do have this particular zone, but nothing taps into that. We can start to see break of structure. So we can see valid point of interest that we could look at. Mitigation, which would bring us to here. We break structure right here, we break structure right here. Therefore, this would be a valid supply zone. Then we can see that we break structure here, and this point does in theory mitigate this, but we don't actually break structure. So again, if we're looking at this little bit, so we'll just go back. So we broke this structure, therefore it validates this POI as a supply zone on a lower time frame. We get that mitigation, and then price continues moving to the downside. What we can see is we do move to the downside, but we don't actually break any true structure. We sweep liquidity, so let's just move that. We sweep liquidity, and we've mitigated something. And then what we can see is price mitigates this wick. We break structure, and then we create a supply zone. So we have sweep of liquidity, we have a mitigation, we have a sweep of liquidity, we have a mitigation of this, and then we have a break of structure. Therefore, this is a fairly high probability zone, but what we can see is then we move to the upside. We tap into more of this area before we continue running to the downside. But again, we're just trying to understand what's happening here to put ourselves in the best position. We could have taken a trade here, and there's nothing wrong with that, because how would we have known that price was going to come up higher and interact with whatever is resting just above? Because we wouldn't actually know that price is going to move or pop up to the upside. The only indication that we could have is when we look at the concept of internal range liquidity once more. We know that we have a lot of swing points in structure. What does this end up creating? Creates a lot of liquidity that's resting there. We have that liquidity void, so we know that chances are price is probably going to fill that to a certain regard. So we're able to look and say that all of this has been mitigated, so chances are something up in here would make sense. Again, I would be more poised to look at this wick, which we never actually tap into. So that would be a missed opportunity, more than likely on my side. But again, this is where we start to look at the 1 minute and we can start to see price reacting off of these areas. See if there is something that would rest within here to look for entries. It's getting a little bit more involved or a little bit more in depth than what I want to do in this video. But again, it's just explaining that we would not have really known that this was going to pop to the upside. The only way we would be able to really figure that out or have an indication that it could happen was, one, that we have all of this structural liquidity right here, and the fact that we haven't actually tapped into this supply zone as well. And we're starting to create relatively equal highs, structural highs that then we see getting swept right here. And now what we'll do is we'll just go back down to our 1 minute example that we've been going on in the last two videos. I'm trying to showcase the same examples just to show how we can add on these probability increasers to just understand what we're seeing on the charts, and that way we can make sense of everything that we're seeing. So now if we look at that first trade again, we have that sweep of liquidity, the break of structure, and what we can see is the first supply zone doesn't really get interacted with. As we can see, price then moves to the downside. We take liquidity, we create a supply zone, we break structure, and we take liquidity, which is why this is a valid supply zone. And what we can see is this supply zone right here is valid because we take liquidity, we break structure, and we mitigate a previous supply zone. Then we move on to this supply zone, which we can say we did sweep a little bit of liquidity, but it's definitely not as proper. We did sweep some liquidity here, so the option is there for you. It's not as clean, but what we can see is, what do? We break structure and we mitigate this supply zone. Therefore, a valid supply zone that increases probability because we have that break of structure and we have that mitigation of a previous supply zone. Now again, if we look at this, we have a break of swing structure. We have this inside bar, we have inducement, price taps into it and runs. And what we can see with this one is we take liquidity, we've mitigated this, and we've broken structure. Therefore, this should be a valid point of interest. It holds, and then we continue moving to the downside. And what I can do is I'll just drag this over, although we know that it was more or less we'd be interacting off of this zone. But what we can see with this supply zone as well, we get that change of character, that sweep of liquidity. Again, minor break of structure, so whether you're going to classify that, but again, this is why we're explaining this bit on why this is still a valid area that you can choose to trade. Why? Because we swept liquidity. We did break some structure. Again, arguably, if we broke structure, yes, on the seconds time frame. 1 minute, not so much. But more importantly, what did we also do? We mitigated a previous supply zone. So we have extra factors in our favor to look for a potential trade. We also have that level of inducement to look for an entry. It improves our overall probability of that supply zone trade playing out. Again, when we look at this one, this gives us more confidence to take this particular zone. Why? Because we broke structure, we took liquidity, and we mitigated a previous supply zone. Therefore, this looks to be a great point of interest or supply zone to look to trade. We move on to the next one. We take liquidity, we mitigate a previous supply zone, we break structure, we break structure, we break structure. Very great looking supply zone to look for future trades to be taken. Move on to this one. This one does not mitigate anything. We just sweep liquidity, tap in. What we can see at this one, we don't take liquidity, nor do we really break structure. Therefore, this point of interest that would be created more or less from this doji, not the highest probability. Why? Because we're not seeing any true commitment. We're not seeing a sweep of liquidity. We're not seeing a real break of structure that's created from this. Yes, we do have a small break of structure here. We create another break structure, would push us to look here. Have we mitigated anything from here? Arguably, no. Yes, we have this, which is our pivot supply. We did break structure, but again, we're starting to look at small little details, but we're trying to look at the overall swing structure. And again, this is where it comes back to critical thinking. What is this? This ends up being internal range liquidity. We have a point of interest that rests above it that has all the confluences that we need. Break structure, break structure, break structure. Mitigate something to the left and sweeps liquidity. Now we're just trying to wait for price. Now we're just being patient and waiting for price to return back to that. And now we're starting to understand liquidity that is being dropped for the purpose of inducing to tap into that particular zone. And then what we can see if we just move on to the demand zone side of things, now that we know that price does in fact react off of this, we have sweep of liquidity, break of structure that changes trend. We're reacting off of a higher time frame demand zone. We tap into this, great. Now that we have our mitigation, we sweep liquidity, we break structure. This area right here has all the probability that we need, that chances are this will be a valid trade. And what we can see is price does eventually react and respect that zone. Now, if we look at this bit of price action, what we can see again, just a break of structure, a little bit of a sweep of liquidity, but the sweep of liquidity in my mind is a little bit convoluted because it's a little bit different on how this demand zone came to fruition. So not so much of a great or valid point for me to look at. What we can see here again, break of structure, sweep of liquidity, we create this POI. Now we have this point of interest that breaks structure, sweeps a little bit of liquidity. We have a mitigation. We have a mitigation of that zone, but ultimately this does not hold. Why? Because we're creating internal range liquidity. So we'd be starting to look for different points on a lower basis to look for entries, but there'd be nothing wrong with looking for an entry here and looking for an entry on this wick. If you were looking for something on this, then that's when we have to start running through our probability increasers. Yes, it does break structure. Does it mitigate anything? No. Does it sweep liquidity? No. That's why this area does seem a little bit more high probability. We sweep liquidity, we break structure, we mitigate a previous demand zone. And that's why, if we just zoom in and look to the right of this wick, that's why we do get a small reaction, but then an eventual fail in price action. And now we can move on to this supply zone. Again, sweep of liquidity, break of structure, valid supply zone. We also have a mitigation of a previous supply zone, therefore higher probability supply zone being formed. And then we move on to this one. Again, we said we don't really have a sweep of liquidity, we really just have a break of structure, and we have inducement below. This one we have sweep of liquidity, break of structure, mitigation of a previous demand zone, which is why this wick is a very valid demand zone to look for buys. And then one other thing that we'll just go over is a little bit more recent price action right here. And what we can see is when we're looking at a change of character, we're tapping into a higher time frame demand zone. So we know that the likelihood of price potentially looking for a reaction to look for buys and maybe even reversing trends to start putting in higher highs and higher lows on, say, a 15-minute and 4-hour chart start to increase. So now we're just looking for reasons to look for entry. So these red lines are our change of character on a 15-minute. But what we can see here on the 1-minute chart is as price comes to continue down, we react off of a demand zone. This demand zone sweeps liquidity. It breaks structure. We see that price does get respected. We get another tap into it. If we're looking at this as a demand zone, has it broken structure? No. Has it swept liquidity? Arguably, no. Has it mitigated something? Yes. Therefore, it is valid. But then what we can see is when we react off of it, we get a slight reaction. What are we dropping? We're dropping equal lows. What is likely to happen? We're going to break to the downside. We also see these structural highs. So chances are internal range liquidity for future use. And then what we can see is we break to the downside. Then we start to move to the upside. We get a reaction to the upside. Have we broken any structure? No. Have we swept liquidity? Yes. Therefore, valid POI. Would you look to trade that? Probably not. That's pretty aggressive to look for a trade there, but we're starting to use that as a basis. Now what we can see is this point right here. Did we break structure? Yes. Did we sweep liquidity? Barely, but yes, we did. And have we mitigated something? Yes, we have. Okay, now we're starting to see valid, very valid points of interest, demand zones taking place. We're starting to tap into, again, a higher time frame point of interest. Now we can see this point of interest, whether we use the inside bar or the inside bar plus the wick or just the wick. If we're using the wick, we can see that the wick doesn't get respected. When we're on the 1 minute, I tend to include the inside bar plus the wick just for consistency purposes. I mean, at the end of the day, the zone itself is only about 2 pips, so it's not the end of the world. But what we can see is, do we break structure? Yes. Do we sweep liquidity? No. Do we mitigate something to the left? Yes, we do. Okay, valid point of interest. Move on to the next point of interest. We can see, do we break structure? Not really. Yes, this inside bar is indicative of a range on a lower time frame, and more than likely on a seconds time frame that would be a break of structure. So yes, we could argue it is a break of structure. Is it a clear 1 minute break of structure? No. Does it take liquidity? Not really. Yes, we have some lows here. Again, on the seconds chart, we could classify those, but we're looking at 1 minute structure. Does it take liquidity? Not in a formal sense. Does it mitigate something? Yes, it does. Therefore, valid point of interest. And we continue on looking at this. We have a push to the upside. Do we break structure? No. Do we take liquidity? No. Do we mitigate something? Yes, valid. And then we continue on. We can see that we have this wick now. Do we break structure? Kind of. Again, this is lower time frame structure, but we're starting to wick structure. We're taking out the liquidity of this. Have we taken liquidity? No. Have we mitigated something? Yes. Therefore, it is valid, and we can continue that process. But again, this is why we stack our probabilities in our favor, because what we can see is, in this instance, yes, we did mitigate something. Yes, we kind of broke structure. Does that sound like we should be taking a trade? No. But what it is framing our minds up from a logical perspective is we're starting to see order flow taking over. We're starting to see respecting of demand zones and price continuing. But on the flip side, what is that also showing us? Price hasn't really moved. We haven't really seen a huge move to the upside. When we're starting to see demand zones getting respected and that process of mitigation taking place, we should start to see large moves to the upside. And what we can see is if we just scrunch the chart to the upside, we do consolidate for a while. But what we can see is we have a demand zone here. If we look here, again, we tap into it. We've broken structure. We can see that we've actually broken true structure. All of this is more minor structure until we break swing structure on the 15 minute. That's our true change of character on the 15 minute. We tap in. So we have a mitigation. We break structure. Do we take liquidity? No, we don't. But that's okay. Then we can look at this bit. We take liquidity. We break structure. We create a valid point of interest. Yes, we've mitigated something to the left. Can we use that as a valid point of interest? Yes, we can. We can see it does wick lower, about 0.7 pips. So whether we stay in that trade is a whole different story. But again, valid point of interest. And we can just keep going and looking at this process. But the biggest and most important thing to understand is using these probability increasers for supply and demand zones, breaks of structure, sweeps of liquidity, mitigations. If we can combine all three, we can create high probability trade ideas. We don't necessarily need all three. And again, like I said, you'll see that breaks of structure and sweeps of liquidity are a lot more common than mitigation. And one thing we need to factor in as well with mitigation is sometimes when we get too many mitigations, we start to create structural liquidity. So we need to be careful. But if we start to see large moves away from that, then what we can assume is that process of mitigation was an accumulation of orders to then start changing momentum. And again, when we've seen this where we took out liquidity, we broke structure, we mitigated something to the left, this is a valid point of interest. And what we can see is we do get a proper respect of it. But then what we can see is the tap into it creates more internal range liquidity in the form of equal lows. Therefore, sell side liquidity is more than likely resting below these. And what do we end up getting? We get a sweep of that liquidity, break of structure. We tap into that. Yes, we could argue that this is just mitigating this area as well, but more importantly, we sweep liquidity, we break structure. And it gives us an opportunity to use this as a future point of interest. We haven't actually seen anything happen with this point of interest, but then what we can start to see is we break structure. We can start to look at these areas, and then we can see price run off to the upside eventually when the momentum takes over. But it's looking at that sort of price action and understanding what's going on behind the scenes, how price is interacting with supply and demand, how we're interacting with liquidity, how we're interacting with market structure, things like that to build high probability trade ideas. It's all about reading all of the clues, looking at information. If you're looking at a trade and you're like, well, it's kind of mitigated, well, it kind of broke structure, well, it kind of took liquidity. If you're not certain about it, just don't take the trade. Use it as a probability increaser for your next trade, because if you get a kind of break of structure, a kind of mitigation, and a kind of sweep of liquidity, but you're not sure whether you'd enter it, don't enter it. Wait for price to return to that area. Say, okay, is price going to respect it or not? If price does respect it and say we get a true break of structure, a true sweep of liquidity, and a true mitigation, or the combination of two of those or just one, then you can start to say, well, I know that we're seeing the process of demand being respected, for example, and that first zone was a little iffy for me. I didn't have that warm fuzzy feeling, but now that I'm seeing all of these factors playing into the next zone, that gives me more of an indication that price will respect that zone. But again, we are factoring in the higher time frame market structure. We're understanding the concept of internal versus external range liquidity and supply and demand to combine all of these into a convenient package to understand what's happening behind the charts. Because if we don't understand market structure, we can't understand trend. And if we don't understand trend, we don't understand the direction. If we don't understand supply and demand, we don't understand the concept of fair exchange or buying and selling, which is causing the imbalance in the markets where large orders are being placed. And if we don't understand liquidity, we don't fully understand where pockets of orders are resting within the market. And if we don't understand that, we don't have a strong indication of where price is likely to move before we see true moves when we're balancing the order book. And if we don't put all of these concepts together, we can't frame up high probability trade ideas that go in the direction of the higher time frame. We're not putting ourselves in the best position for looking for entries. We're not being targeted as liquidity because we're entering too early. So what I would recommend for all of you to do that are watching this video now is, again, go back to your charts, look at mitigations, look at price returning back to supplier demand zones and creating new supplier demand zones and seeing the power of that, whether it's for actually taking trades or just starting to build confluence for order flow to be built. Because as I said, when we were looking at this little bit of information, we were starting to see a change of character before we got the change of character on the 15-minute chart, but we were able to understand what was happening on a 1-minute time frame. We were able to see the order flow switching from bearish to bullish. And while some of these points of interest were super aggressive and didn't have a lot of confluence, as we start to see them building up, it gives us more probability to start looking for trades. So if we didn't take this one, that's okay, because we didn't really have any indication. If we didn't take this one, because again, we didn't have a whole lot of indication, that's okay. If we didn't take this one because we didn't have a whole lot of indication, that's okay. We start to see our 15-minute change of character. We're starting to see impulsive nature into the chart. Then we can start to build trade ideas within this bit of price action, because now we're starting to see that picture come alive. We don't have to be the first into any trade. We can just stack probability in our favor and make the most informed trading decisions, because at the end of the day, that's what trading is all about. It's about being smart. It's about putting as many factors in your hand as you possibly can so that you can make informed trading decisions that ultimately make you percentage, that make you R or make you money. So again, just hit your charts, start studying this stuff. Again, if you're the concepts of internal versus external range liquidity or structure, or even just basic supply and demand zones are still a little bit fuzzy as we've gone through all of this. I'm trying to build on everything into a convenient package as we continue. And as we're building on, I'm trying to add everything in so that you can see that they all do work in hand. So if there's an area you don't understand, I strongly encourage you going back to the previous videos, studying them so that you can understand, because everything just continues to build on from here as we continue on.